Hello student, here's Jean-Pierre Milo from Ultimate Traders Company Limited. Today we are going to run a new episode of our series of Forex trading for beginners. Without delaying, let's meet after the intro. Welcome back to our YouTube channel UTC FX, and before we go to today's lessons, let's do a quick recap of what we learned in the previous lessons. And the previous lesson have learned what is called the Forex risk management, where we have seen that risk management is a set of rules and measures you set for yourself to ensure that any negative impacts which comes from a trade you made could be manageable. We want to be emotionally free, and we want to stay focused while trading in order to avoid the poor trade psychology. And we've seen that we have seen also that risk management will not only help you to do not blow your account, but it will help you also to be profitable in the long run. We have learned also the position sizing, where we have seen that position sizing is just setting the correct amount of the units you want to buy or to sell a currency pair, just to reflect the maximum risk you want to, you believe to encounter for this particular trade. This is what we learned from our previous lessons, and if you do not remember that, you can go to the link on top of your screen to remind yourself what we learned in this course. And before we start the new lesson of today, if you are new to our YouTube channel, please subscribe so that you don't miss up the upload of the next lessons. Hit the like button if you see or you find the file valuable. This information is sharing on our channel, and share with your friends and the family so that we can also run these golden and important lessons about Forex trading. Without delaying, let's go to the today lessons. Today, we have covered a lot about the basic of Forex trading, and we are now closing to the we are nearly closing to the end of the basics or all the necessary information needed to become a Forex trader. So today we are going to see how we enter and we exit the trades, because that is what we do in Forex trading. We time our entries and our exits in order to make the profit. And today, in today's lesson, we are going to see how we enter and we to exit in the Forex and in the trades. And this process of entering and exiting the trades, it is what we call order in Forex trading. There are different types of Forex orders, and that's what we are going to learn today. Order simply, means it refers on how you wish or how you will enter or exit a trade. That is what we call order in Forex trading. As I mentioned, there are different types of orders. One which is commonly used by the scalpers and the many traders, it is what we call market orders. Market order, it is just to enter instantly, or it is to execute instantly at the price which the broker provided to you. I hope you remember we spoke about the ask and bid price, and these are the price which the brokers quotes for the traders, where and they refers to the price where you can buy or sell the basic currency. So market order, it is an order which is executed instantly from the price offered or provided by the Forex broker. We'll see that later when we go to the trading platform. The second type of orders we have, it is what we call pending order. A pending order, it is just an order that is executed at a later time at the price you specify. Let's say your broker gives you want to buy a currency pair, let's say for this example GBP USD, and the broker wants you, is providing you to buy it at 1.0.0234. But you see that this price which the broker gave you, it is a bit not very good for you, or you are not comfortable with your price. And let's say you can make an order. Let's say you wish to enter at 1.0240. So it is possible to make a pending order, so that only if the market reaches this price, then your order is executed. You see, this is a late price, and it is a price you specified yourself. It is what we call a pending order. These pending orders, depending on what you are doing, they have different types, and we are going to see them in details, how they differ. There are what we call limit orders. Limit orders. A limit order is simply it is a pending type of pending order, but it is an order placed either by below the market or sell above the market at a certain price. So, which means that we can have a tool which we call buy limit and sell limit. Let's go to let's make an example. Let's say you see that the market, it is here. This is the current price. And you do not want to buy at this current price, and you see that maybe it will be better to buy at this price. Let's say this price, it is 1.2340, and you wish, or you want to buy from 1.2330. You see there is a difference of 10 pips from here. So, and it is here. So you can wait the price to come back down, and then buy from here. But sometimes maybe you have a full job, and you have no time to watch and to monitor your screen to make sure that the price is alive to this price. So you can make a buy limit at this price, and close your machine and go to your job. If the price reaches this price, your order will be executed, and if the price bounces back from there and it continues up, then you will be in a profit. This is what we call buy limit. For sell limit, this is the trade with the order executed in the market when we want to sell. Let's say you think the market will go down. Currently, the market, it is at this level. The current price, let's call it the current price. And you have no time to watch your screen all over the time to make sure that the price will hit the price, let's say, which is here. Let's say 1.2330, and the current price, it is 1.2320, for example, and you wish to sell at this price, but because you have no time to monitor your screen, you can make a limit order, so that if the market rises and reach this price, then your order will be executed, and then if it goes down, you will be making a nice profit. This is what we call limit orders, and we have a buy limit and sell limit. These types of orders, they have advantages and disadvantages. The advantage is that you buy at the best good price, best possible price. That is why you are buying or selling your asset. The disadvantage, you can be triggered, and this market instead to go down and continue up, and then it will be hit your stop loss and you can counter your stop loss. Another disadvantage, it is that sometimes it cannot reach your preset price and then collapse back, which means that you will miss a trading opportunity which you had. Let's continue with the next type of order. It is what we call stop order. Stop order, in a difference with limit order, a stop, they have also different types. There is a stop entry order and a stop loss order. Stop entry order, it is an order which we use to enter the price, to enter into a trade. But a stop entry order is an order pressed to buy above the current price or to sell below the current price. This is, let's go to the whiteboard in order to see the difference between the stop order. Let's say you have your current, the market, it is trending up, and the current price and the market, it is now making a correction down, and you wish, and this is where the price it is currently, and you wish to buy at a certain price here. You see, you want to buy above this price. So it is that you want this market to start going up, and when it reaches to this specified price, you enter the market to take you, and you enter with it and continue higher. This is what we call buy stop. For sell stop, it is an order we execute when we are selling. It is when you simply want to sell below the current price. Let's say the market it is collapsing down, and you want to sell, and currently the price it is at this price, and this is the current price, and you wish to sell from this point. So this is what we call sell stop. It means if the market collapses down, it will come and you will join the trade and then continue the market down. This is what we call buy stop entry, buy stop and sell stop for entry of the trades. So we have two, so it is a buy stop and sell stop for, and if this help us to enter into the trades. Another stop order we have, it is what we call a stop loss order. A stop loss order, in contrary, it is a stop which is linked to your trades, and it is main purpose it is to help you to prevent you losing more than you set for yourself if the market goes against you. Let's go back to the white chart to make illustrations whether you are doing a buy limit or buy stop. To make it clear, let's use for example now a limit order. Let's say the market it is trending up, and now it shows you that it is trying to make a corrections, and you wish to buy at this broken resistance, which could turn resistance. This is broken resistance which could turn support. This is where you want it to buy near this resistance. But because you do not have time to watch your market at every time, Then you do, for example, you have a full-time job, or you are a student, and you wish and you do not want to lose this trade. As you have seen, you can press a buy limit here, buy limit here, so that if the market collapses down, we'll come and pick you and go up with it. The disadvantage, one of the disadvantage of a buy limit, as what you said, it might come and trigger your order, your buy limit order, but then continues lower. If it continues, you can even end up by losing your entire capital. So to protect ourselves, we place another order below here, which is equivalent to the loss, which we call stop loss order. And for this case, it will be, our stop loss order will be sell limit. It will be a sell limit. So this means that if this market trigger our entry and does not respect our prediction, instead of bouncing back and continues lower, it means that we need to set a limit which we cannot exceed in order to make sure that our loss will be limited and managed. This means that if this price continues lower than this stop loss, you will exit the trades immediately, of course with a loss, but with a manageable risk. Let's say, for example, if you have a 10,000 account and you have the risking 1%, which is $100. In this case, you will end up, we go down with a loss of only 100. And this is good and manageable from a 10,000 account, because if it was there, let's say the market, if it could continue lower, you could lose more than this money. This is what we call stop loss order. It helps us to manage and to control the loss we could encounter while trading. Another type of order we have, it is what we call trading stop loss. It's the trading stop loss order. It is an order which is also attached to a point TN when open positions, and which automatically moves with the profit when it becomes profitable. Let's also go to an example. Let's take an example again. Let's say you see that your market, it is trending up and it made a retracement from this broken resistance, which could then support, and you pressed a buy stop here, buy stop, and you pressed your stop loss order here, and there is a type of order which is called trading stop loss, which you can attach to this trade. And if this market, let's say it obeyed you and it moved up to this point, then you see that you are in a profit. So this stop loss, if it is a trading stop loss instead of a fixed stop loss, and you made it a trading stop loss, this stop loss can move with the market. Let's say by this time, let's say the market has moved from this point to here, your stop loss will no longer be here. It will move, let's say, the same distance from this one here. In this time, there will be, let's say, our stop loss will be here. Even though the market comes back below, of course, you will exit the trades, but you will be able to secure this profit made here. So you see, it is very nice to book a profit and to make sure that you will not lose the entire money if the market moves in the direction, and that is what we call trading stop loss. These are the main order we do use most of the time in forex trading. There are others, but the most used one are these market order and pending order. And in pending order, we usually use buy limit and sell limit, buy stop and sell stop, stop loss order, and trading stop loss. These are the orders that are most used in forex trading. There are others. If you are also very interested, you can make your due diligence. But believe me, these ones are enough to be profitable in forex trading. I hope you enjoyed this lesson, which will help you and which will teach you how you will be executing your trades. And if you wanted to know more about this type of orders, go to our website www.ultimatetraders.rw. And if you are new to this channel, please don't forget to subscribe to our channel UTC FX so that we know when the new lesson is uploaded. And don't forget to hit the like button to support our channel and to share with your friends and family so that they can gain from these free forex contents. See you next. Thank you.